We found an unusual trade worth $66.6 million on Alphabet or Google stock, ticker symbol GOOG, on the last trading day, January 31st, when the stock hit a new high. And what's also very unusual about this is that Google reports earnings in a few days on February 4th. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying Google before earnings or bearish and selling Google. Because as we all know, the rich have more access to information, including leaked insider information, such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so to level the playing field, let's dive into the unusual option activity that represents their trades. As we can see here on the options, time, and sales tape, on the last trading day, January 31st, at 2:36 p.m. at the 3-second mark, these unusual options were being traded for the April 17 options at the 220 strike calls, 7,208 of these, and the 240 strike calls, 3,604, but 2 times. And so if we multiply by 2, you can see that this is actually 7,208, which corresponds to this 220 strike calls, because these are being done simultaneously as a spread, as well as these 185 strike puts, 3,604. And so we have a ratio of 1 put to 2 call spreads. So keep in mind as we analyze this data even further. We can see here on the option chain for these April 17 options, at the 185 strike puts, we have an open interest of 2,519, which is less than the 3,604 being traded. So we know these are new opening trades, as well as the 220 strike calls. Open interest, 2,373, which is also less than the 7,208, as well as the 240 strike calls, 507. And so all 3 of these unusual options that expire April 17 are new opening trades. And based on our analysis, they were selling the 185 strike puts and buying the 220 strike calls and selling the 240 strike calls. But remember, we had a ratio on the call side that was 2 to 1 on the put side. And so we need to make sure of that when we analyze this trade. And so we can see here on the risk profile profit loss graph that this is what their trade looks like, where the x-axis represents the share price of Google, which is currently trading over here, and the y-axis represents the profit loss. Note the zero break even line here. And so when the purple and blue lines are below it, it is a negative loss. If it is above it, it is a positive gain, because this is a long bullish trade. And we can confirm it on the Greeks here. We have a positive delta trade. If it was a short bearish trade, it would be a negative delta. Now keep in mind, this trade is hedged, and that is why this blue line, which represents the date of expiration, is flat. It does not lose in profits all the way until about $185 a share, because they sold the 185 strike puts, which means that they are willing to own 100 shares at this share price. And so we multiply that out and we get $18,500 of buying power required per contract for every put that they sold. And we know they sold 3,604 contracts. And so we multiply that out and we get a total trade that required $66.6 million. And so quite a significant amount of capital. But keep in mind, earnings is coming up. And so this is a higher risk trade in comparison to the trades that we share on our website. If you want to get access to the lower risk, higher probability of profit trades, then go to our website.
Visit www.unusualoption.com to join our membership and start your journey to a financial success with a partner you can trust.
We will put a link to our website at the top here, where you can also learn trading strategies to further reduce risk while increasing the chance of profit. Because keep in mind, not all of these unusual trades will be profitable. even this one might be a loss. But as long as we diversify with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. And so if you want more stocks wealthy investors or insiders are trading for your portfolio diversification, then go to our website. Now, with that said, we still traded this, but we use position sizing to manage our risk. You can see here our position at the 220 strike calls. POS stands for position, green means buy, and red means sell. We did not sell the 185 strike puts because they require a lot more capital. And so we want to save our capital for the lower risk, higher probability of profit trades that we share on our website. And so we bought these 220 strike calls and we sold the 240 strike calls for $4.40 each. And when we analyze this trade, you can see here that this trade is a vertical call spread, which is also going long bullish because as the share price goes up, this trade becomes more positive profitable. And notice the max profit showing up over here in blue at expiration is $1,560 per trade, which means our risk to reward ratio of 1,560 reward divided by the risk of 440, which is the cost of the trade, is a ratio of 3.54, which means we could potentially make 354% profit on this trade. So the risk to reward ratio is in our favor, where we could gain more than what we could lose. And so that's one of our strategies when we trade with options. However, there are other risks involved in this trade because you can see here for our theta decay, we have a negative theta, which means that as time goes on, this trade loses value. And that is why the purple line, which represents the current date, drops down below zero. And so our break even shifts upwards to about $224.40, where the stock needs to trade above to be profitable, even though we bought the 220 strike calls. And so be aware of the risk with trading these options. If you want to learn more strategies to reduce risk while increasing the chance of profit, then make sure to go to our website. We'll put a link at the top here. And let us know in the comments below. Do you think Google will rally and make higher highs after earnings, or will it crash back down? As usual, please hit the like button, subscribe if you haven't. Take care and have a wonderful day.